Hello, hola, you know who I am. I'm your girl, Rena MoMoney. And on this channel, we talk about real estate. We talk about ways to help you crush it, ways to help you succeed, save money, and make money. Well, today we're going to talk about the truth about getting a loan to buy a house. So whether you are a first-time home buyer and you haven't yet bought your first home, or whether you are an investor trying to buy your first investment property, regardless, we're going to talk about getting a loan to buy a house. So come on in. House loans are certainly harder to get due to the recession, but it is possible. So you say, let's get into it. Let's talk about getting a loan to buy a house. First thing you want to do is check your credit score before you begin applying. That's very imperative, very important. You need to know your score before applying. If you are applying on a personal end, there's some things you will need to do. If you're applying on your business and you're trying to get a loan in your business name, there's some things you need to do. You say, well, what are those things? The second thing is you must have active trade lines, active and open, regardless if you're trying to do personal loan or a business loan. You must have open and active trade line. And I've released cards to build your credit on each video. I have cards streaming across on the videos all the time, and most of those cards help you to build your credit, whether you're doing your personal or your business. Sometimes I have business credit cards, and sometimes I have personal credit cards. So make sure you take some time out, and when you do listen to the video, look up at the screen to make sure that you're getting that valuable information. So first, you want to check your credit score, and second, you want to make sure that you have active trade lines open and going. The third truth about getting a loan is you must pay down your debt. Must pay down your debt, because your debt over ratio is going to be important, and we'll get a little deeper into that. But to pay down your debt, you want to start out by disputing errors on your report. You remember, you're going to pull your report, so that's the first thing. Dispute any errors on your report. That's going to be what you want to do after you pull it, after you start looking into your trade lines and seeing what you need to have open, after you get some credit cards. Then you want to make sure you pay down your debt and dispute errors on your report. Now, although you're paying down your debt, still remember you need to have the fourth thing here, which is emergency funds. And usually the golden rule is 6 months of your expenses. So if your mortgage is going to be $2,200, they want you to have $2,200 times 6. If your mortgage plus your other bills that you have that's going to show up on your credit report, you need to have that plus your mortgage amount. So if your estimated mortgage is $2,200 and you have $600 in credit cards a month and then another $600 in other debt, then you need to have 6 months total. Whatever that total is, you need to have 6 months reserved in the bank for that. So after you dispute your errors on your report, you want to have that emergency fund. That's really imperative. As I'm going along, I'm pretty sure a few of you are probably saying, okay, well, my credit score is so low, I don't have a credit card, or I couldn't get the credit cards that you mentioned on your YouTube channel, Rena MoMoney. I couldn't get it. Something happened. My credit score is just too low. It's hard for me to build. I need to do secured credit cards, and guess what? I don't even have any money to secure it with. Well, here's a tip. Here's a secret. Become an authorized user on someone else's account. That someone else needs to have good credit, and their credit cards cannot be maxed out. That's a good tip. So if you're at the bottom of the barrel, then become an authorized user on someone you trust, someone that would trust you, and someone that you already know that credit card situation is good and financial situation is good. Again, if that doesn't work, if you have a little bit and you're not at the bottom of the barrel, you want to get secured credit cards. Use it, pay it off, then do it again. Use it, pay it off, and do it again. So as we're talking about credit, as you can tell, it's very important. Your credit score, your building of your credit is very important to getting a loan. You also want to try to turn your money into credit. You say, huh? What do you mean, Rena MoMoney? Well, instead of using cash for gas, get a gas card instead of cash, especially while you're building. Remember, get it, use it, pay it off. Get it, use it, pay it off, then do it again. But each lender will look at things differently, and each lender is different. Okay, now that we got the basic out the way, let's go a little farther. Before I do that, I want to make sure I mention my subscribers, my new subscribers, my commenters. You know, I like to give shout outs, I like to give thanks, I like to give claps up. You should congratulate yourself and be happy that you are taking the steps to become a better you, and you are educating yourself. So thank you for coming on the Rena MoMoney channel. I can't thank you enough. I really appreciate it. It keeps me going. Make sure you like or either comment. That helps the YouTube algorithm. So if I've helped you in any way, if any of these tips have ever helped you, any credit card, any tip, please like. If you have subscribed already, please make a comment. It's greatly appreciated. Thank you, thank you, thank you. So clap it up for yourself. Now, in reference to loan is the mortgage. So let's get a little deeper into the loan. So if primary or investment property, you still need to identify the right mortgage. Okay, you say, well, what do you mean? Rather, it's a FHA, a conventional, a VA, a USDA, a jumbo loan. You need to identify the right mortgage. FHA is very, very popular because it helps individuals with low credit scores. Most lenders want at least a 580 credit score. Some will take a 560, but then you will need 10% down or more and have a low debt to income ratio or low debt to income score. So FHA is designed to help. So consider FHA if you know you have a low credit score, but you have positive in other areas, like you have a good sturdy job, you've been there a while, you have the 10% down to put on the house. So FHA is the best mortgage way to go. But with the multifamily, you can put down 3.5% with FHA. Keep that in mind if you're doing multifamily. So I'm kind of switching back and forth if you're doing an individual loan, if you're doing it for business as an investor. So just kind of keep up, do your own diligence, check it out, learn the difference. I'm trying to at least touch on some of the different types of mortgage and to make sure that that mortgage is right for you. Like a conventional loan. A conventional loan, you need at least a 620, and the rate right now is around 7.5%. With a conventional loan, you can put 3% down if you're a first-time home buyer with a conventional loan. Now, a lot of investors also go with conventional loan because they may have that 620 score or higher, and it's a little easier, especially if you have a 700 score. It's better going with the conventional loan if you only want to put down a little bit of money. And most time investors, we want to put down as less as we can. So a lot of times conventional loan is the right way if you're doing investment, if you're trying to get investment properties, and if you're trying to put a little bit of money down. Now, here's some tips for you. If you're self-employed, you may have to provide extra proof of your financial stability. So keep that in mind. I know some of you are investors, you're new, you still have a job, and some don't have the job, you've already left. I don't know your situation. I'm trying to kind of cover some of the truth about mortgages, about getting a loan to buy a house. So if you are self-employed, just keep in mind you may have to provide extra proof of your financial stability. They may ask you for 3 months of bank statements. Some may ask you for 6 months. Some may ask you for a whole year. It just depends on their program and their project. All right, let's keep going. With the conventional loan, you can request it to be removed after you have certain amount of equity, like after 20% of equity has built up in that home. You can request that PMI, that mortgage insurance, be removed if you have a conventional loan. But the difference is with the conventional loan, you can get it removed after you have 20% of equity. How you get it removed? You have to send in a letter. You have to write that. If you need help on that, if you need help on any real estate situation, I do coaching calls. So make sure you look down in the description, schedule a coaching call with me at Canley.com/RenaMoMoney. Anything to do with real estate, I can help you out. Just have your questions ready. Educate yourself, invest in yourself, pay for a coaching call, pay for a course, pay for a script, pay for what you need to get above. So that was basically some of the different mortgage types. I didn't go into the jumbo loan. I didn't go into VA. I didn't go into USDA. VA is a very good program. They pretty much guarantee the loan for veterans. That's what VA means. The most popular loans are the FHA and the conventionals. Of course, you have the hard money loans, and there's some more out there. There's some more programs. That's something that you'll have to get into and make sure that you have the right mortgage for yourself. I did want to mention a few other things about the truth about getting a loan. Some may think assuming is the next best thing, and it can be. Assuming the mortgage, it can be. You have to qualify to assume a mortgage. So keep that in mind. Each lender handles pre-approval differently. You do assume the current debt, you assume everything. You assume the interest rate that person have, and each lender will have to qualify you if you assume the loan. Keep in mind, subject to is not assuming the loan. So keep that note for yourself. But if you do assume the loan, it can be good too. And it may be some situations that require you, okay, it's probably best that I assume this loan on this great deal. So just keep that in mind, that you will actually inherit everything about that loan. You assume the current debt, you assume everything. Sure, there is a huge difference in subject to the existing financing and assuming the loan. So if you're doing a subject to deal, of course, you're not assuming the loan. Keep in mind, VA loans have no PMI. If I'm saying anything to help you out, if I've given you any information or given you some tips or given you something, please smash the like button. Please smash the like button. That helps out. Also, look in the description. I have some information and some resources that can help you out. Take some time out and educate yourself. Another truth is your down payment does not cover all your closing costs. Some people think that the down payment cover all the closing costs. It does not. If you have to come up with 3%, that does not include your closing costs. That's something you'll need to talk to your mortgage broker about, or your realtor, or if you're trying to understand that, the closing title company will help you out with that and getting a better understanding of the closing costs. I want to share another truth to know. Your score will take a small hit when you apply for a mortgage loan. So be prepared to apply for the mortgage loan. That's why I say pull your credit first, because you want to make sure you have at least that 620. The higher your credit score, the better your terms will be. Keep that in mind. So having a low debt to income is always a plus. I always tell you, keep it at 25% or lower. That's a tip to go on. Always consider the pros and cons for a 15-year mortgage, a 20-year mortgage, or a 30-year mortgage, whichever one fits you and your financial situation. Some folk are ready to do a 20-year mortgage. You can save money on interest. You can save money in so many ways if your mortgage is shorter. And I also have a video on telling you how to shorten your mortgage even shorter. So if this is your first or your primary home, look at doing a 20-year mortgage instead of a 30-year mortgage. Even check out a 15-year mortgage and see if it'll fit you. Do your own due diligence. Check that out, because everybody's financial situation is different. You're on this video, you're on this channel so that you can become a better you and make your financial situation better. So hopefully this video was helpful. Please make sure you come back next week full of information. Thank you, and you take care.